So what I tend to find in practice is there's many people out there, many companies out there that proclaim to offer wealth preservation services and consulting services. My one concern is there's a lot that needs to be considered when putting together a proper wealth preservation plan. So we sometimes speak of things like family frameworks, estate planning. The concepts like this all fit into this perfectly, because remember, at the end of the day, yes, wealth creation is great, and I mean that is exactly why you need a property coach. You need to learn how to create that wealth. You need to build it. But once you have it, you need to be able to utilize it properly. You need to be able to save it. You need to be able to transfer it across generations. It's that intergenerational wealth that really creates powerful families sometimes, and wealth that lives on forever. So how does this all tie in? Take, for example, marriages. So many people, for example, they spend so much time focusing on how they're going to get married, what marital regime they're going to use. But sometimes when getting to the investment space, they take on structures that completely defy the need for those marital regimes. And the unfortunate thing is we do live in a world where divorces do exist. It's something that comes day in and day out. And it's not necessarily always unfriendly divorces or tense divorces. Sometimes things just don't work out, and we need to remember that when entering into joint venture agreements with people, sometimes things don't work out, and we need to cater for that. So when you're dealing with marital regimes, as many of you know, you can get married in community of property, out of community of property. And when you get married out of community of property, there's something that's called accrual, and it either applies or doesn't apply. And all this effectively means is that at some point or another, our government, or common law in fact, and our government came out with certain standards, certain principles that we use when getting married. In community of property, everything is shared. There's a joint estate. If you get sued, the other person gets sued. And that's why typically my advice when getting married is please don't get married in community of property. It is not ideal at all. There are no benefits. And if it is a question of trust, where one has to ask, but I know that nothing's going to happen to this relationship, you can mimic that in out of community of property. Why would you do that? Because the reality is, even if you don't get divorced, why would you want to allow your creditors to be able to attach her estate or his estate when you're the one that might maybe go into financial trouble? And that's what in community of property does. Out of community of property, you tend to keep the estate separate, meaning that your creditors cannot access the other person's estate. Now, what does this have to do with wealth preservation? Now, you're married. You come to us and now we say, great, create a trust, throw everything into the trust. Then we're kind of missing the point, because the whole thing with getting married out of community of property with accrual or without accrual was so that you had a marital regime that governs that. And this is very, very important, guys. Don't take that cookie cutter advice of just put a trust and throw everything in there. If the idea was to keep certain things separated, and the reality is that both parties agree that these things were meant to be kept out of the marriage, we need to structure your estate so that it stays that way. Be very careful. Do not make the mistake of effectively changing your marital regime, not legally. I mean, you're still married in a certain way, but by your investment structure can mimic your personal life. And that is our tradition, our motto when it comes to planning, is we want to take your personal life and we want to be able to mimic it from an investment side of things. We want to try and get to a point where your personal estate has very little and everything is spread across different investment vehicles, but it needs to mimic your wants, your needs, and why you got into things in the first place. Your business partners, your relationship with your spouse, your relationship with your siblings, with your parents. There's no point changing all of this now just to get an investment structure at a certain price range, or just because somebody says it's a good idea. It needs to be done meticulously so that you can mimic what you need in your personal life into your investment life. I'd like to thank everyone for watching us. It's always such a pleasure. It would have been amazing to do this in person, but we are at a time where unfortunately that face-to-face interaction is not possible. But I hope that you got a lot of value out of this. And there's just certain points that are so important to emphasize. I mean, we spoke about the 3 principles. We then explored around these 3 principles. We gave little extra nuggets of information that tie into these. But guys, the reality is these 3 principles govern how your investment structure should look like. Everyone has their own needs, and I cannot emphasize this more. You have to tailor make your investment structure to your needs. There's a lot of companies out there that proclaim to do wealth preservation, but the reality behind it is getting a cookie cutter model isn't always the best answer. And sometimes it's not even just the model from the beginning, it's how the model is implemented, how it's executed. It's more about just getting a trust and thinking, well, I've got an investment structure. It's not just about that. It's the combination of getting the investment structure and actually being able to execute it the way that you're supposed to execute it, with a plan of action. And I worry about things like this because sometimes people don't find that perfect balance. A cookie cutter approach or a standard form approach, you receive these vehicles and you get told that this is how you should do it, but you don't quite understand why, and it might not fit your particular requirements. So take, for example, asset protection. Some clients of mine are risk averse. Some clients of mine aren't at all. They want to take risks. They're very aggressive, in fact, when it comes to risk. Understanding risk management is paramount. And the structures will differ depending on how aggressive the client is or how conservative the client is. In fact, there is nothing, maybe the client doesn't even realize whether they're conservative or aggressive. You look at age grouping, for example, someone reaching retirement is going to approach their investments very different to someone that just started out in their career. That's why it's vital to have a coach that can look at your investment profile and be able to assist you through it, but your structuring also needs to fit into that criteria so that you've got the right structure in place from a long-term perspective. So that's asset protection. Tax efficiency, very similar things. Some people need to use the money today. Some people don't need it today. Some people want to keep it for very long periods of time. Some people have family dependents where they can utilize the money in a very smart tax-saving way. Some don't. Some are older, which means that their tax liabilities may not be as stringent as somebody that's younger. There's a variety of different reasons why your tax efficiency is approached differently. And I mean, your financing optimization, need I say more? We walk around, each one of us, able to obtain some loans, others not being able to obtain others. Using other people's money is very dependent, and it's very subjective. So the reality is the structure, making sure that you're in a prime position to be able to get that funding. It really depends on who you are and how you're actually able to access that funding, how your personal affordability is, how reliant you are on needing to actually get this company to a point where it can get its own loans. All of this, how quick you need that passive income. Someone reaching retirement needs to move a lot quicker at the risk of the banks not wanting to grant loans anymore, as opposed to someone, again, at the start of their career that's building up an income and is able to rely on their affordability a lot more. All these things are tailor-made, so be very careful who you use. Make sure that you're comfortable, that you understand your investment structure, that you understand the implementation, and that you have the right people on board with you. My name is Bruno Simao. I really hope that you enjoyed these videos, and yeah, hopefully we'll be doing many more of them, and we'll be able to speak very soon.